Most traders lose money for one very simple reason. They chase. They buy after the price has already shot up, or they sell after the price has fallen too much. I'm sure that's happened to you. And then what happens? The market snaps back and they're stuck holding a losing trade. Why? Why does this happen so often? Because most traders don't have the right tools to figure out the best points to buy and sell. That's why. So in this video, I'm going to show you a trading strategy that can help you stop chasing your trades and dramatically improve your risk to reward ratio and win rates. It's incredibly simple. Hi everyone, I'm Kathy Lien with BK Traders. If you haven't done so already, don't forget to subscribe to our channel and hit that notifications bell. I don't want you missing any more of our valuable trading tips. Now, here's the reality. Markets will trend, and trends when they get underway can be very, very strong. This is especially true of the Forex market, but also for gold and indices. Prices can shoot higher for hours, even days, without giving you very much of a pullback. If you're watching the chart, it can feel like the market will never come back down. And in that moment, FOMO, the fear of missing out, sets in. And it is so tempting to chase, to hit that buy button at the very top or sell the very bottom because you don't want to miss more of the move. But that's usually when the move is the most dangerous, because the further the price stretches away, the worse your risk to reward ratios would be. So what can you do about this? The first step is to use a tool. And a very simple tool could be the 20-period EMA, or the exponential moving average. Put that on your daily chart. This acts as your balance point. If the price gets too far away from it, it's a warning that the move is maturing. Momentum is getting stretched, and the risk of a reversal is rising. Now, this is very important because in a strong trend, price pulls back quickly to the 21 MA. If you're buying far above it or selling far below it, you're begging to get caught in a snapback. Now, let's break down why that matters and how you can use it to time better entry points. First, the distance from the 21 EMA matters. When the price is miles away from the 28 EMA, you can see it on the chart, you're not buying strength, you're buying potential exhaustion. That's when the trades or traders can get tricked into selling at the very bottom or buying at the very top, and I don't want that for you. The move looks powerful, but it looks already overextended. And because your stop is usually wide and your target is small, you end up with terrible risk reward. You're basically selling the low and buying the high. That's not trading, it's gambling. That's why I always avoid trading when the price is too far from the moving average. Second, wait for the dip back to the moving average. Now, this is a real test of patience. The test of patience is to wait for the high quality risk to reward trade. So, if you're in a strong trend and price is stretched far away from the 21 EMA, instead of chasing it, wait for the pullback. If it's in an uptrend, look to buy when the price dips to the 21. You want to make sure that the candle closes. If there are wicks below the moving average, that's fine. In fact, it may even be better because it means that level's being rejected. I'll show you how this looks in the live chart in just a second. But if you're trading a daily chart, like I'm going to show you, what you'll probably be doing is setting a stop of 100 pips on the other side of the moving average. I know 100 pips seems large, but these are big trends that you're trying to ride. In a downtrend, you want to do the opposite. Wait for the bounce up to the 21 EMA and then sell with your stop on the other side. This way, you're entering at value and not exhaustion, and your risk to reward ratio will improve dramatically. Now, I would stay in the trade until it moves 50 pips back below the moving average. Don't worry, I'm going to show you how all this looks on the chart. Okay, so you're looking at a Euro-dollar daily chart, and what I want you to do is I want you to add in the 21 EMA. Just click on indicators, type in EMA, go to the technical section, which shows the exponential, moving average exponential. Click on that. And we are going to change this to the 21. It defaults as the 9. So we're going to change this to the 21 EMA. So the point I want to make is that when we are too far from the moving average, that signals potential exhaustion, like you see here. And you can see a very similar case over here. When we are getting far away from the moving average, the chance of exhaustion, the move ending, grows. So what's a better place to get in? What's a better trade? Well, a better trade would be to wait for what I call the dip back below the moving average. So if we're looking over here, a good opportunity, a classic example is over here. And remember, we want to wait for the candle close to make sure that we close back above the moving average. So this candle, we've dropped back below the moving average. That's not a valid candle because the close was below it. But the next one, this candle tells us that the drop held, that basically, this support level held. And so that would be a really good point to go long. And going long at 108 close, a stop down here at 107. It never moved back it. Stay in the trade until it closes back below the moving, or drops back below the moving average by 50 pips. So that would be about 111.75. So you're entering in here 108 to 111.75, which is about 375 pips. So this is a very nice 375 pip move. So let's see another example. This one, it retraces back. No, don't take this trade because it closed back below it. That's fine. We rise above it. Now, we're not getting very overstretched here, but still, maybe there's some opportunities to get in. This one would be a valid entry point because we dropped below and we broke below the moving average, and then it closed back above it, which means that there's strength. This is a strong candle. So you go long at 113.65. And your stop is 112.65, doesn't go anywhere. It doesn't even retrace back below the line. We stay in this trade until it drops 50 pips below this, which is 115.50. So we got in at I think it was 113.65, 115.50, so almost 200 pips on this trade over here in the euro dollar. Let's see what else. These are not valid trades because it dropped it, it held it, not a good one. Now, could you go short? Yes, maybe, but this is a new move. It hasn't really been a strong trend in place. And this is where sometimes you want to bring in some of your other technical indicators to see whether or not we really have a real pullback or a real break. This shows you that the bottoms are still being held, so it's not necessarily true. Now here, we don't have a retrace. This is also not a valid trade because it pierced below it. So far, no valid trades. This is not a valid trade. This is not a valid trade. This is a valid trade here. In this case, we probably still would be in this trade. Where euro-dollar closes back above the moving average at 116.70. Your stop is 115.70, and it would not have stopped you out. You're still in this trade, so you'll have to see. Now, going back to previous examples here, let's see where we could have a setup. So let's find a long trend. So this probably would have been a failed trade, which is not a big deal because you lost 100 pips here, but you made a lot more money here. So you would have sold after a drop back below here on a close of 107.30 or so. And you would have stayed in this trade until 103. So the moving average is at 103.50, so 104. So you sold 107, 104, so basically 300 pip move on this one over here. Here, there's no trade over here. This one, you're in the short zone. There's also no trade over here. This over here is a trade. You would have gotten long at 104.25. And it did retrace, but didn't stop you out because the low was 105.95. And boom, 104.25. You would have gotten out of this trade. Let's see if you would have gotten it here. 425. And this trade, actually this trade would have turned into this trade. And that would have been almost an 800 pip move. And you would have foregone this, but this would have been an 800 pip move. So really strong swing trades. But the point is not so much, how much you can make, but that you really want to trade closer to the moving average and avoid the ones that are far away. And this is another good example here. You don't want to sell here because you got really bad risk reward. You want to wait until you can sell over here, or wait for a drop below, sell over here. And yes, you would have given up some move, but at least your risk reward is good. And and your stops are logical. And that's the most important part of this. A third approach is to use the moving average as a trigger, which is a great strategy for those shorter time frames. I'll also use a combination of this, which is that if I'm looking at my daily chart or the 4-hour chart and the price is too far away from the moving average, I may also avoid the trade on a short-term basis, even if my signal is there. Now, on a 15-minute chart, for example, if the price breaks above the 21 EMA on a closing basis, I want to make sure that I look for a trade example and I look for a potential trade. I can't stress this even more. The candle needs to close. When it does, you can take a long entry with a stop, maybe 20 pips on the other side of the EMA. I'll show you in the chart. Why? Because if the break is real, the price should stay above the 21. And if it collapses back below, your small stop will save you from a big loss. The same logic works in the reverse. If price breaks below the 21 EMA, you can enter short and place your stops 20 pips on the other side. Stay in the trade until there's a close back below the moving average. So now we're looking at euro-dollar on a 15-minute chart. With 15-minute chart, you have to have tighter risk reward. And, it's very simple, which is that if we've gotten very overstretched, like over here, I wouldn't say this is very overstretched, but if it did get very overstretched and it got moved very far away from the moving average and it drops back below the moving average on the other side, you could have shorted here with a stop of 20. So you would have shorted at 116.67 with a stop of 116.87 and gone for, a 1-to-1 risk reward, or maybe 10-15 pips. It's more of a scalp on the other side. This one, we did get overstretched a bit. It got moved away from it. So this probably would have been a valid trade to the upside. This one over here, this is when these are too close. This is when we did get far away from the moving average, so you want to wait for a cross back above here. So wait for a cross back above here, 116.70. It does kind of grind for a bit, but eventually goes up about 20 pips, 15, 20 pips. That's where your profit target is. And your stop should be about, I said 20 to 25, but probably 15, 20 pips is probably sufficient. Here, once again, this is when it gets overstretched, but we really don't have a trade because it doesn't close back below it. We do have one fake trade over here that didn't work out, but it does retrace back up. But this one was a very nice trade. We got a nice gap here between the price and the moving average, closes back below it on this candle over here. And this one, it does retrace a little bit, but you're in this trade, becomes a very nice move that drops it almost 30 pips. Looking at it in daily charts is much more effective because it's looking at a long-term trend, but it can also be very valuable on a shorter-term basis as a frame of reference. So hopefully, you can see the difference that this will make for your risk reward and for timing better entries using a very simple tool like the 21 EMA just to help you to gauge whether you're buying exhaustion or buying a good retrace. And that's really what you want, because when you chase and you buy or sell when the price is far away from the moving average, once again, your stop is going to be wide, your profit is going to be small, your trade is basically 1-to-1 at best. But by entering near the moving average, you can keep your stop tight, 20 to 25 pips, and aim for a much bigger move on the shorter term charts. Even 100 pips on the daily chart is a small stop. And that can give you 1-to-2, 1-to-3, or even better risk reward ratios. Suddenly, you don't have to win every trade. You can be wrong more often than you're right, but I don't want that to happen to you. And there are many videos here where I try to teach you ways to have a higher win rate, but you can still come out ahead. So next time when you're about to hit the buy or sell button, check how far is the price from the 21 EMA. If it's stretched, don't chase. Wait for the setup. Trade close to the moving average and you'll stop giving away your money by buying highs and selling lows. Just remember, avoid trading when the price is too far from the moving average. Now, if you found this video useful, hit that subscribe button and make sure you hit the notifications for more trading insights. And if you're ready to take your trading to the next level, check out our favorite brokers and prop firms in the description of this video. And I'll see you in the next one.